Financial Literacy is an educational program which airs on Waves 1170 every Sunday night at 9 p.m. Hosted by Hubert McIntosh, a CPA and member of SOFA, the Society for Financial Awareness, with the number one goal: assist individuals to take charge of their personal finances. Please join us every Sunday night at 9 p.m. on 1170 a.m. or via your smartphone app, Waves 1170, or on the internet at waves1170.com. Waves 1170. 1170 a.m. It's Sunday night in the Caribbean month. Hubert McIntosh is a member of the Society for Financial Awareness, and he's the man. Financial literacy provided by Hubert McIntosh, CPA. Financial literacy. Control your financial status. Here's your host, Hubert McIntosh, CPA.
Good evening, good Sunday evening to you again. We are back with you on a beautiful Sunday evening. Thank you for joining us. This is part 2 of life insurance, clearing up the confusion. Last week we had part 1. This week we're going into part 2. I am Hubert McIntosh, your CPA. We're here to take your calls also. If there's anything out there on your mind, please don't hesitate to call us. The lines are open, 954-792-1170. 954-792-1170. As I said, I'm Hubert McIntosh, your CPA and a member of SOFA. SOFA is the Society for Financial Awareness with the mission to help eradicate financial illiteracy in America, one community at a time. And we're starting with this community. Have joined SOFA and have partnered with them for this community. So thank you for joining us. So last week we spoke about life insurance, clearing up the confusion, part 1. And that recording has been posted. So if you go on the website, financialliteracy.info, financialliteracy.info. Just follow the media pages, whether it's Facebook or Twitter. Last week's recording have been posted. So if you missed last week, you can catch up on that. But we're going into part 2 this week. So as you know, it's Sunday evening. We are in Sunday school. So I encourage you, you're gonna need your pen tonight. You're gonna need your paper. I'm gonna share information with you. Last week we started it. Some of the information, it's gonna be contradictory to what you have heard. Yes, I said it. Some of it is gonna be contradictory. Last week we spoke about it. We said it's gonna be controversial, but no, prefer to use the word contradictory because it's not controversial in a malicious way or anything like that. So I prefer to use the term contradictory in the sense that you may have heard things differently from what I'm gonna share with you tonight. And there's a phrase I introduced you to a few shows ago, and I'm continuing going to use it in the sense that if what you thought to be true turned out not to be so, when would you want to know? And I'm going to assume your answer is right now. So we're going to dive into it. Last week we spoke about qualified plans. We were comparing with life insurance. We spoke about the history of life insurance. We spoke about term insurance, and we started going into permanent insurance. So that is where we're gonna pick up. We spoke about regarding term. Someone can have a 20-year term. We even gave an example last week of someone taking out a $500,000 policy, $529,645, and they would be paying $1,200 for the year, while we're comparing where that same person could have put in $10,000 for the year to get the same $529,000 death benefit. So where we've picked up on is if someone can pay $1,200 for a particular product, why, for the same death benefit, why would they pay $10,000 if they can pay $1,200? And that's where we left off. That's where we're going to pick up, where we're going to identify and we're going to dive into why someone would pay $9,000 more for the same death benefit. So with that being said, here's the first one. Here's the first one statement that you're going to hear that you may have heard it different before. Life insurance is not just about death benefit. Yes, I said it. It's not just about death benefit. You know, previously, if we go back 40 years ago, most life insurance was just for death benefit. But we also gave you an example regarding your smartphone. There was no cell phone 40 years ago. There was cell phone 30 years ago. And the cell phone that was there 30 years ago is not even the same, because 30 years ago, that phone was just to receive and to make calls. Now, your phone is considered a smartphone. So it's the same way with life insurance. We now have smart life insurance. Yes. And we're going to share some of the details of it to identify why is it considered smart. The phone lines are open. 954-792-1170. 954-792-1170. The website, you can go on the website to post any comments or any questions, which we would really appreciate your feedback. It's financialliteracy.info. Financialliteracy.info. So let's dive in. All right. So we're going to talk about life insurance, permanent life insurance. Last week we spoke about term insurance. What term insurance is? It's for a particular term, whether it's a 10-year term, 20-year term, 30-year term, 35-year term. I think that's the highest one out there. So what that simply means, whenever that term expires, that life insurance expires. So we are using the model of a 45-year-old person. If a 45-year-old person buy a 35-year term, at the age of 80, that term has expired. So here this person turns at 81, they have no more life insurance. Okay, so what's the contradictory part about that? Because you have people believe that if someone is now 80, their children are grown, so they don't necessarily need life insurance anymore. And that was coming from the school, the thought that life insurance is just for death benefit to help you out, just in case you die when your kids are young, and your kids will be able to have some income coming in. So that school of thought believes that, well, once your kids are grown, then you don't need life insurance anymore. And that is the myth that we are going to debunk. We're going to debunk that myth tonight. We're going to break it up. We're going to dive into that. So the last caller we had last week wanted me to talk about life insurance, permanent life insurance, which is also called cash value life insurance. So we just gave you the example about the term. So we're going to talk about cash value now. Cash value life insurance, the other name for it is permanent insurance. So what it is saying then, the belief there is that insurance is going to be permanent for as long as the person lives, versus a term which expires after a certain period of time. So with cash value / permanent insurance, what happens is that it's accumulating cash into it. So you have the death benefit and you also have cash. So with that even said, now it gets a little bit more now confusing, because the same cash value insurance, there are two types. We're going to talk about two types particularly. You're going to talk about whole life. Whole life is that insurance that has been around probably since BC. It's just whole life has been around forever. So a lot of people, when they hear about cash value or permanent life insurance, they're thinking, well, it's just whole life. Well, remember we started the premise. We're talking about smart insurance. In the 70s, so you go back to the history lesson again now. Remember, not everything, a lot of things in the financial arena started changing in 1974. So if what you know prior to 1974, and that's all you know, then you're gonna be so lost, in the sense that things have changed so much since 1974. So I encourage you, get your pen, get your paper, because we're gonna talk about the changes. The phone lines are open, 954-792-1170. 954-792-1170. So we're going to start by comparing that, because we were talking about qualified plans, the comparison between insurance investment. And I know sometimes the insurance industry does not like to use the term insurance investment, but I'm looking at from the premise that if you have something that you invest, you put money in, anything you put money in is an investment. And if that money is increasing, your investments are increasing. While on the other hand, if it's decreasing, your investments are decreasing. So we're going to use that premise, whereas an individual can invest in a life insurance product and they can invest in a qualified plans. So let's talk about the benefits. What are the benefits in a qualified plan? And let's define it again, just in case you forget. Qualified plans are 401k, 403b, 457, 408a, 408b. You may not realize that, but 408 are IRAs. IRAs are under the code 408. So you'll have 408A, 408B, where one is traditional IRA, one is a Roth IRA. And that came about in 1994, somewhere near there. So you see what I'm saying? If you go back 40 years prior, there was nothing like Roth. There was nothing about Roth. There was no IRA in that sense. There was no 401k. All of these things came out in the 70s, starting in 1974, under the act called ERISA. ERISA means Employee Retirement Income Securities Act. That's what ERISA was, and that bill was passed in 1974. It took a while to get implemented. Wow, the clock is just running, folks. Folks, the clock is telling me that I have to step aside for a short commercial break. So get your pen, get your paper, stick and stay with me. We'll be right back. And staying with us, the time, that first quarter hour went by so fast. I realized I got to speed it up because I got so much to share with you tonight, So we're talking about the comparison. We started talking about reminding you about what qualified plans are. And remember, all these plans we're talking about, the qualified plans and the insurance plan, they're all a part of the Internal Revenue Code. So when you hear the term 401k, it means Section 401k of the Internal Revenue Code. When you hear 403b, it means 403b section of the internal. So all of those are internal revenue. 457, 408. And the life insurance one, you can make a note because A lot of you may not be familiar with it. It's 7702, a part of the Internal Revenue Code. So let's put them side by side, because I introduced you to qualified plans a couple of weeks ago. Last week we started talking about the comparison, clearing up the myth with life insurance. And I promised you that this week we were going to compare them. We were going to put them side by side. So when you hear a qualified plan, the number 401k or 403b, what that is, to break it down, it's a vehicle. It's like you have a vehicle, like you buy a car. You may go on the lot and you may buy a car. So think of those plans as you buy a vehicle. But that vehicle, for that vehicle to run, that vehicle, you have to put gas. You have to put gas in that vehicle, because if that vehicle doesn't have gas, it's not gonna move. So it's the same way now with a qualified plan. You have to put gas in it. And what are the gas that you could put in it, in the sense that you could put stock, bonds, mutual funds? But because it's qualified and it's measured by the government, it's governed by the government, in the sense that the government doesn't want you to just put straight bonds. In a lot of cases, those plans, you cannot put bonds in. You can put stocks, but the most common are mutual funds. So a lot of times you will hear that 403b, 457, it's a mutual, it's mutual funds. It's funded with mutual funds. So what does that mean? Where it's comforted in knowing that mutual funds, it's a group of stocks put together. In some particular case, it could be 100, it could be 200, it could be 5, it could be 1,000 stocks. It just depends on how that manager, because all of these are managed by a person or persons that you'd call a fund manager. So what they would do, they would choose a group of stocks and they would put it in one bucket, and they would call a mutual fund. So one manager may have a mutual fund with 500 stocks. Another one may have a mutual fund with 200 stocks. Another one may have it with 1,000. So there's such diversification where sometimes people get confused. People think that because the term mutual funds, it means it's the same mutual funds, and that's not so. Because one manager, you may have something with Fidelity, you may have something with Merrill Lynch, but it's a different group of stocks. So I just want you to be aware of that. So that means you're directly into the stock market. You're directly into the stock market, which can be a plus and can be a minus. So if the market goes up, if the average goes up with those funds, you could go up, your investment could go up by 20%, which is good, where someone would say, yippee, that's great. But the contrary part to that, if the mutual funds, if it goes down by 20%, wow, then you have lost 20%. So we're not going to focus on the loss. I'm going to make it, I want to have it an even playing field. We're not even going to focus on the loss. We're going to say it's just going to go up. It's just going to go up. So we're eliminating the market volatility. I apologize for that. The market can be volatile. So we're going to eliminate that for now and just focus on the plus. All right. So the plus of the mutual funds in this particular case is that as good as the market does, you can do. If the market goes 20%, your funds goes up 20%. If it's 30%, you go up 30%. And as I said, we're not going to talk about the market the volatility of the market, and we're not going to talk about the fees. We're just going to talk about the market itself. All right. So what's one of the benefit of the qualified plans is that the taxes are not paid when you're contributing to it. So I gave you the example last week. You put $1,000 in because you don't pay the taxes. That $1,000 can go to work immediately. But if you're in a tax bracket of 30%, remember that tax is postponed, you know. But the beauty of it is because that $1,000 working instead of 700, then you have the potential that your portfolio can increase faster. But the risk of that is that if the interest, not the interest rate, sorry, if the tax rate goes up above 30% when you're going to make your distributions, then what happened there is that you're going to be paying a higher tax rate than the 30%. The phone lines are open, 954-792-1170, 954-792-1170. So on the other hand, now you win because, and I know most people believe that when they get to a senior age, then the tax rate is going to go down. So let's go off that premise then. If the tax rate goes down, yes, that person wins because what they did, they postponed the tax from a high tax rate to a lower tax rate. So that's one plus with qualified plans, and outside of that, there are not many benefits because it's for income. It's income. You're putting in money and your money is growing. And then at a certain time, you're going to choose to take distribution. Yes. So let's talk about that now. So say, for instance, I ran a brief analysis here in comparison. So say the person at 45 and they put in $10,000. They put in $10,000 a year for 20 years. So they get to 65 now and they have $328,000. Right? So let's use the same $10,000 for the insurance. So that insurance, that 7702 plan, has $328,000. So we're going to call it equal that at 65, they both have $328,000. Okay? Because we have eliminated, we're not looking at any fees. We're not looking at markets going down. So we're assuming that both parties will have the same $328,000. And they decide now that at 66, they're going to start taking $31,000 in income. Okay? $31,000 in income. And the money that's there is still increasing at 7%. So we are making it equal that both are increasing at 7%. Okay? So the scary part of that now, in the sense that I ran the calculation here. In the 401k or in the qualified plan, taking $31,000 a year and you're getting 7%, that money, that $328,000 at age 85 will only have $7,300 left in it. After 20 years, it will have. So the person got $31,000 per year for 20 years. So basically, they got $620,000, something like that. But at age 85, they basically ran out of money. I want you to think about that for a minute. So here it is. You have a plan at 65. You said you have retirement, but your money ran out at age 85, while the same person with the insurance, their money doesn't run out. The money goes until age 120. Wow. That's one of the things I'm telling you that's going to be contradictory, because that, just hearing that for the first time, it can really put you in a mind boggle, because how can at 65 two people have the same money, one run out at age 85, the other one goes to 120. And the only reason why it's 120 is because there's no living person past 120. So the insurance company calculates it just at 120. The highest living person right now, I think, is probably 117. I think that was the last statistic I got on that. All right, the phone lines are open, 954-792-1170, 954-792-1170. So it's fair enough that I have to explain to you how can the same money last 35 years and one run out at 20? All right, here's the thing. When you're taking a distribution from a qualified plan, so remember with this person started taking it at 65, you're taking an income distribution. Income distribution. So when you take 31,000, that principal of 328 is decreased by the 31,000. Think about that for a minute. So the 328 is decreased by 31, where it is now 297,000. And that 297,000 is what the interest rate is calculated on. So your question would be, isn't it the same with the insurance? No. Because the money that you're taking from the insurance is not, even though it's income, it's a loan. You're borrowing the money from the insurance company. I don't know, this time is just flying so much. I have to take another short commercial break. Stick and stay with me. We will be right back. Welcome back. Welcome back. Thank you for sticking and staying. Wow, the clock on the wall is just flying. I know I left you with a bombshell there, and I know you must have been wondering, wow, what is this? Taking a loan. How can they get a loan from the insurance company? Okay, here it is. When we talk about that 328,000 at age 65, that's in the qualified plan, and in the insurance, we have the 328, where both of them as the same 328,000. Here is the difference though. With life insurance, for something to be life insurance, it has to have a death benefit. It has to have a death benefit, else it's not life insurance. So when you look at that Internal Revenue Code I mentioned to you, 7702, what 7702 allows, which I just gave you the brief number where it runs out, the money that you're getting, that loan from the insurance company, is tax free because it's a loan. Anytime you get a loan, whether it's from an insurance company, whether it's from the bank, loans are not taxable. So here it is. You're getting an income distribution from your IRA or your 401k. And income has to be taxable, but loans are not taxable. So that's one part of it. And you're saying, but how can they get a loan? What happened? That loan is from the insurance company, and it's collateralized by the death benefit. Because remember, that same person we spoke about, they had a death benefit of $529,000. So the insurance company gives the loan and use the death benefit as the collateral. You know, so those are the numbers part of it. And I know you're being introduced to this for the first time. It may be a little bit fuzzy out there, but we have a website, financialliteracy.info. Financialliteracy.info. You can post your question, you can put your comments, reach out to us. You can email us support@financialliteracy.info, support@financialliteracy.info, and we can help you look at your personal situation, because I'm just giving you an example here. It doesn't mean each person's situation is different, but we can help you to look at a customized situation and use your data so that you can see. So from a numbers standpoint, so right there you see that the insurance wins. But say you don't believe in the numbers part. Let's move from there then and let's go somewhere else. Okay. All right. As you may see here, for those of you who are looking, insurance solves 3 puzzles. There are 3 pieces of the puzzle for insurance. As I said, mutual funds solve 1. It generates income that you will have a retirement income. Insurance solves 3 puzzles. And you look at it here. It's die too soon. That's what we're familiar with insurance about. Die too soon, the death benefit. But insurance also solves the next puzzle. Live too long. Remember I pointed out to you earlier, just using the numbers. One person ran out of money at 85. So if that person lived past 85, do you think that will be a calamity? That will be a calamity. If that person lived past 85, they ran out of money. Wow. Remember I shared a statistic with you guys a couple weeks ago. There's a statistic and you can Google. Check me out. Everything that I tell you. But when you Google, you got to know that you're going to hear good stuff. You're going to hear bad stuff. So you got to know who you're listening to. You know, there's a statistic that by the year 2050 in America, there will be 4 million centenarians. 4 million centenarians. That's people who are 100 years old. There will be 4 million of them in 2050. That's the good part. But here's the scary part. The scary part is that 99% of those centenarians will be broke. 99% of them will be broke. And you ask me why. I just showed you an example. I just showed you an example with the qualified plans, 401k, 403, where you have people that this is their financial plan. And if you don't have a supplemental plan, then you could run out of money at age 85, just using as an example. So I encourage you, I encourage every one of you, get a financial plan done so you know what your status is, your situation. We just work with a client the other day, and when we finished with him, he wanted to retire. His money is gonna run out at age 99. That man was very happy. His money was gonna run out at age 99, and we help him to enhance it that now he will never run out of money. And you may say, how is that possible? Yes, that is possible with proper planning. So that's why I have been sounding like a broken record, encouraging you to get your financial plan done. Get your personal economic model, because we each have a lifetime capital potential, and not everyone lifetime capital potential is the same. Each person is different. So you cannot get and go by what your friend or your mother or your cousin says. Your plan, you have to get a customized plan for yourself. The phone lines are open. 954-792-1170. 954-792-1170. Okay? So I spoke to you about the second puzzle that insurance fix. You have died too soon, you have lived too long, and now the scary one, become ill. Become ill. Does any of you out there ever experience where someone becomes ill, but they don't die? They don't get better, and they don't die. So sometimes that is called chronic. You have chronic illness. You have illness that are continue. What do you think happen when that person illness prolongs? And sometimes this is not necessarily even terminal illness. So I'm not just talking about terminal illness. You have illness which are critical, but they're not terminal. But this mere fact of that, it's gonna cost this person money because they have to get medical care. The health insurance is gonna pay for the health part of it if they have health insurance. But what about the other part where the person where the person needs a caregiver? Person needs a caregiver. If they can't work, then somebody has to assist them. Where is that money gonna come from? But I am happy to report to you that you have insurance that takes care of that, because insurance, you have insurance with living benefits. Okay, so I understand there's a caller on the line, so we're gonna go to that caller. Caller, you're on the line. Hello, caller. Hello. It looks like we're having a little bit of a technical difficulty. Caller, you're on the line. Hello.
I don't know what happened because I'm talking to you.
Okay, caller. Okay. I'm hearing you, caller. Please go ahead. How can I help you?
Yes, I hear you talking about this financial plan.
Yes.
So can I get a little more information about it?
Well, what happened, and I'm glad you asked that question, caller. What happened, each person, and that's why we don't discuss fully the financial plan on the line, because we give it general, because your situation is going to be different from another person's. So we can help you look at your situation, so you can email us. You can email us your information, and we'll get back to you within 24 hours.
No, I don't really have an email. So can you give me another number that I could call you off the line, off the air?
Yes, the operator will take your number, and then we will get back to you, and we can help you customize a plan.
Okay.
All right. So the operator will take your call, take your information. Thank you, caller. We appreciate it.
Thank you, and have a good night.
You too. Thank you for calling.
Okay, bye-bye.
Yes, so we thank that caller there. She's interested in a financial plan. And this is part of what we do as providing financial literacy. And in doing that, as I said, I come alongside this community. All of that is complimentary, folks. We're here to do a community service where we want to help you. We want to help you to be financially literate. That is the purpose of this program. And that's why we have come alongside SOFA. Because SOFA is the Society for Financial Awareness, where the goal is to help eradicate financial illiteracy in America, one community at a time. And we're starting with this community because what we're hoping that we're sharing with you, that you will not fall into that statistic of being financial illiterate. And that is why we're coming alongside and trying to share this information with you. So utilize our service. The phone lines are open, 954-792-1170, 954-792-1170. You can email us, support@financialliteracy.info, support@financialliteracy.info. You can go on the website, financialliteracy.info, financialliteracy.info, and you can make your comments, you can put questions. We will get back to you within 24 hours. So utilize our service. We're here to serve you. So as we were talking about, oh my gosh, the clock on the wall again is telling me that I got to take a break. So stick and stay with me. We'll be right back. Welcome back. Welcome back. Thank you for sticking and staying. We understand that we have another caller, so we're going to take that call. Caller, you're on the line. Hello, caller.
Hello. Yes,
Ye-
sir. Good night.
Good night, sir. How are you?
I'm doing great. Doing good.
That is good. Thank you. How can we help you?
Boy, me never, until me listen to your show, never really understand the level of financial literacy that I myself as a businessman, that I don't have. I'm make investments and everything. I'm in the stock market, but just the program, trust me, it just give me an awareness of the amount of consciousness that we need to have as as an individual when it comes to money planning. And cause just like you said, man, the money run out one day.
Yes.
Run out.
Yes.
It-
Yes.
yes,
Yes. Yes.
although
You're
making
so right. You're so right.
although
Yes.
you're making
Yes.
money, you have bills
Yes.
and everything.
Thank you. That you just sharing that with us means a lot to us, because we are on this air and we're trying to provide this information, and sometimes feedback like what you're providing to us let us know that what we're doing is a worthwhile cause. So I thank you very much. And it's interesting you mentioned that you're a business person, and most of the stuff that we have been talking about is just personal stuff. When we start sharing some of the business stuff, it's just gonna blow your mind. But what we're trying to do, because everyone is an individual and not all persons are business owners, so we have been tailoring the show from a personal level. So I just want to thank you for your feedback. Is there any questions that you have that I can assist in answering?
Well, me definitely will come give you a. I think we see
Hello?
you earlier today still.
Caller?
Hello. Hello.
Yes.
Yeah. No, me see you earlier today. We have a conversation earlier today. I don't know if you remember me.
Oh, yes. Oh, yes. Thank you so much.
Yeah.
Thank you so much, Andrew. Thank you. That's good. So
So
thank you for joining us, man. Really appreciate
man,
it,
yeah,
and
trust
thanks
me,
for the
that was nice.
feedback.
With
So
my ears
when we
moving
get
because-
together, these are just introductions we're sharing with the people, and it's just general. But when we start be able to get directly and dive into where we can help people structure their personal platform, it's just amazing that there are so much opportunities that we have out there, but because of financial illiteracy, we just don't know it. So
Yeah.
so I thank you, and I look forward to be sharing some of this information with you. So you have my contact information,
Yeah,
so
man.
you can
Yeah, man.
you can reach out to me.
And
So
trust me,
thank you
I'll
for your
tell
feedback.
all of my
Really
friends
appreciate
them.
it.
All of my younger guys, because I'm a young
All right.
guy myself, so I just want to get on track with life and trust
All
me,
right,
it
so
make a
so
difference.
moving along, folks. Caller, you there?
Yeah.
I think we probably having a little bit technical
We can hear you loud and
difficulties,
clear.
folks. I apologize for that. We had a caller there. I don't know if we lost him or
Yeah, me can
what,
hear you loud and-
so, but we thank him for sharing that. He has been getting some great benefits from the show, and I hope that most of you out there, if not all of you, have benefit in some ways. But I want to share some stuff with you regarding, since we are on life insurance, and I talk about the old type of life insurance and the new type, like we talk about regarding the phone, the smartphone. So here's what I want to encourage each of you now. Each of you that has an insurance policy, I want you to review your policy. Contact your agent, contact the company, and review your policies. I'm going to share some things with you that if your policy doesn't have these things, then you need to get a review, because that means you have the old type of policy. If when you go on your policy and all your policies says it has a death benefit when you die, then that means you have and not to be demoralizing, you have an antiquated policy. You need an upgrade. You need to upgrade if all your policy has is death benefit. Because I'm gonna share some stuff with you. I'm gonna read off some of the stuff that some of these new policies are providing now. Policies are now providing chronic illness. Chronic illness is similar to long-term care. We cannot say it's long-term care, but chronic illness is whereas if someone cannot do 2 of the activities of daily living, that insurance, whatever the death benefit, and this is how the death benefit is important. We spoke about that person who had the death benefit of $529,000. If that person is diagnosed with a chronic illness that they cannot do 2 of the activities of daily living, that is bathing, continence, dressing, eating, toileting, or transferring. If they cannot do 2 of those, they can accelerate that policy to 90%. That means from that $500,000, they can accelerate that policy and they can get $450,000 to help them with their treatment. Whether they are in the facility or not in the facility, they can get up to 90% of that policy. And that's for chronic illness. I'm going to mention another one now. Critical illness. Critical illness is another one. If they have critical illness, depending on the severity of it, because critical illness comes with different levels. It can be moderate, it can be high, it can be life-threatening. So it has different levels, where if it's the highest level, they can get up to 90% again of whatever the death benefit. And I'm going to read out to you some of the stuff that qualifies under critical illness. And remember, make note, if your policy doesn't have these things that I'm reading out, you need an upgrade. I just mentioned to you about chronic illness. If your policy doesn't have chronic illness, you need an upgrade. So we're going into critical illness now. And here's the list. ALS, that's Lou Gehrig's disease. Aorta graft surgery. Aplastic anemia. Blindness. Cancer, cystic fibrosis, end-stage renal failure, heart attack, heart valve replacement, major organ transplant, motor neuron disease, stroke, sudden cardiac arrest. If your policy doesn't have any of those things that you can accelerate and get funds for, you need an upgrade, folks. And I'm going to run through the list quickly again, because I know it may have shocked some of you that you have insurance that can give you these benefits. ALS, aorta graft surgery, aplastic anemia, blindness, cancer, cystic fibrosis, end-stage renal failure, heart attack, heart valve replacement, major organ transplant, motor neuron disease, stroke, sudden cardiac arrest. Folks, you need policies that you can accelerate up to 90% of the death benefit. If you don't have these, you need an upgrade. Now the one I'm going to talk about, critical injury. Critical injury. What qualifies under critical injury? Coma, paralysis, severe burns, traumatic brain injury. Coma, paralysis, severe burns, traumatic brain injury. So folks, this is what I'm talking to you about when I says to you, the new kind of insurance is smart insurance. Evaluate your policy, call your agents, call the company. If your policies don't have these things, you need an upgrade, folks. So reach out to us, financialliteracy.info. Go on the website, make your comments, put in your questions, financialliteracy.info. Email us at support@financialliteracy.info, support@financialliteracy.info. The clock on the wall telling me I got to get out of here. So we're here Sunday nights from 9 to 10, but you have 24/7 access to us. You can email us, you can make comments on the website. We will get with you. You have 24/7 access with us. Thank you very much for joining us. Have a great evening, and we will see you on the other side. Thanks again.
Financial literacy with Hubert McIntosh on Waves 1170 has come to an end. Don't be mad. He'll be back next week on www.waves1170.com. Hubert McIntosh is a member of the Society for Financial Awareness, www.sofausa.org. Promotional consideration provided by LifelineTax.com.